Please keep eating. Don't let Peter and I stop you. But to respect your time and get those of you who want to get out of here earlier than later, the opportunity to do so, we're going to go ahead and get started now. And so another housekeeping note, just like in prior years, we're going to open up the patio again afterwards. The bar will be open. There'll be cigars on the patio for those of you who wish it. We'd love to have all of you stay. Those of you that can, please do. We'll enjoy your company some more. So, I've had the pleasure, I'm going to take you all on a little detour here. This is an unexpected twist in the road. I've got you all captive audience tonight, so you have to listen to my little detour here. So I've had the pleasure of taking my family on a Mexico home build trip 3 times. We did our 3rd build this past summer, and some of you are familiar with this trip. I've shared it with many of you in the room. And I just wanted to, since we all, many of us anyway, make our living in the business of putting people in housing, I figured this might resonate with you. It's an incredible experience to be able to take a family, a disadvantaged family, in this case a family in a little suburb called Rosarito, just outside of Tijuana, and lift them up off a dirt floor and put them into a real house. So this is just a short video clip that I want to share with you. I thought it might resonate with folks in the room tonight.
Yo me llamo Norma Leticia Guillén Guido, tengo 32 años. El espacio es pequeño, nada más la recámara y la cocina. Que no hay piso, el techo más que nada, sí me preocupaba que llegara alguna lluvia. Y la verdad son experiencias a veces desagradables que a mí no me gustaría que mis hijos vivieran.
Y nosotros ya le habíamos pedido una casa al Señor, le habíamos orado que ocupamos un terreno y una casa. Y yo le había comentado a mi esposa, dije, no, o sea, dije, ¿sabes qué? Yo siento que nos va a bendecir una iglesia del otro lado. Es otro, como dirían por ahí, otro rollo.
We are building a home for a family in Tijuana.
Hope means believing that you have a chance and that you have something in the future for you.
It's been full of surprises and a lot of fun and hard work.
When you know that you have a house and you're not sleeping on a dirt floor anymore, that in itself is a provider of hope.
It's very good. I've never really experienced a time like this.
Our group had a lot of children, and actually seeing them help and want to help has been pretty amazing.
It's been very helpful to do work with my father, and it's also really fun because, I mean, we've never had this kind of experience together.
Working out with other people, problem solving.
And the jobs that they were willing to take on that weren't the fun jobs, but had to be done.
Just the experience of like actually doing something you've never ever done before. Because, I mean, I've never built a house.
It's been fun and it's been good building a house for someone in need.
And I hope that they will be safe in their new comfy house.
Pueden estar seguros que esto es de parte de Dios.
Thank you for letting us be a part of this wonderful build.
Thank you for your friendship with all of us.
Thank you for letting us build this house. Thank you for allowing us to be part of God's plan.
It was a wonderful 2 days to meet you.
It was an honor to get to build this with you, and this is an experience that we'll never forget.
incredible experience. I guess it's kind of a call to action. If you have the opportunity to do something like this, and something beyond yourself in a profound way like this, take the opportunity. And the thing about this is, putting somebody in a house, it transcends politics, it transcends race, it transcends borders, it transcends everything. There are a few more foundational needs than housing. So thanks for letting me share that with you. And now, so I told Peter 15 minutes ago that he had to follow this video, which he was not particularly happy about. Sorry about that.
No, how do you follow something like that? But I'll try.
You'll do a wonderful job, as you always do. Thank you, Peter.
Thank you. So, good evening, and thank you for having me. I'm always pleasantly surprised when Steve asked me to come back again. And so thank you for that, Steve. I always love coming and seeing the folks in Indianapolis. My name is Peter Donovan. I'm with CBRE, Multifamily Capital Markets. I spend most of my time now on our debt side, Fannie Freddie FHA, but I also do continue to have some engagement with our investment sales team. And so from that vantage point, I'm able to see what's going on in various parts of the country in terms of sales and debt. And what I'm going to try to do tonight is to keep you engaged first and foremost, and I hope I can do that, and then hopefully a little bit informed and maybe a little bit challenged. And so I'm not asking you to necessarily buy what I'm presenting, but if it gets you to think, then I think I've done my job. So, Steve, down?
Page down or right.
Perfect, okay. So, I'm going to start with sort of three general themes. One, surprises. And I made some predictions last year that were flat out wrong. So I will share those with you, and you got to own up, you got to fess up. Two, interest rate normalization, because I would argue that what we're going through right now with interest rates still isn't quite normal, although we pretend that it is. And then, as we often do, a quick look at the multifamily market update nationally, and then there'll certainly be some comments about the Midwest. All right, so for those of you who remember Gomer Pyle, right? Surprise, surprise, surprise. All right, so what have we been seeing in the last year? For me anyway, that was a surprise, and maybe for you as well. All right, the Tax Act. Now, I came here last year convinced that we were going to lose a lot of the benefits that we had in real estate for the Tax Act of 2017. And I tried to convince you of the same thing. I couldn't have been more wrong. And I think part of that has to do, quite frankly, for those who are members of the NMHC and NAA, the lobbying efforts, candidly, that they took on in the fall of last year truly made a difference in terms of how the Tax Act came out. So I was shocked that it came out the way that it did, obviously to our benefit. In January, we go to the NMHC annual conference, and it goes back and forth east and west coast. And we meet with about 200 clients, and we keep notes from these meetings. And I went and reviewed the notes about a week later, and I realized that there were 50 CBRE clients who said they wanted to or needed to buy $1 billion worth of multifamily in 2018. 50. The billion used to be a select group, now it's the crowd. When you had number 48 come in and tell you that they had to buy $1 billion, you didn't have a heart to tell that they're number 48, but they are. So I think it just speaks volumes as to the amount of capital that continues to come into this sector. And we'll talk a little bit about the impact that we're seeing that having on the market overall. The other thing interesting to me is this late in the cycle, we're absorbing more units today at 249,000 in trailing 12 months than we have in the last 13 to 15 years. That was a surprise to me. We've seen the political machinations. The stock market just blows right through it. Global economy doing reasonably well, though I'm told recently that Europe is starting to slow down a little bit and has some economists worried. Gradual interest rate and rise in interest rates has not yet impacted values. What we've seen, I think a lot of that has to do, quite frankly, with the 50 that have to buy $1 billion worth of real estate or want to in 2018. We're certainly starting to see some pushback on core value offerings. That may not be a surprise because some would suggest that maybe that should have happened before now. But we are starting to see some core offerings that are not taking, they're not being sold. We're actually seeing this particularly in Texas. And so they're getting pulled because they can afford to hold, the financing is still favorable. We are continuing to see just a frenzy around value add, which is probably no surprise to anybody here. What's surprising to me is, however, even at these numbers, these cap rates for value add, we're seeing price adjustments at best and final 3 to 10% to win. We're seeing people going in with very little contingencies and due diligence in order to distinguish themselves from the pack and be able to win the transaction. So it's still a fevered pitch around value add. So Alfred E. Newman, for those who remember Alfred E. Newman, Mad Magazine. This is probably more a guy thing, so forgive me, ladies. My wife says my humor is infantile, juvenile at best. And this has to refer to interest rates. We are so used to this low interest rate environment, we've accepted this as normal. I can remember 3 or 4 years ago, we were more worried about interest rates and people asking what's going to happen to interest rates than we are today, which is kind of striking to me since we're that much later into this cycle of low interest rates. So, I think all of us as an industry was what we worry. So CBRE, Econometric Advisors, which is our consulting arm out of Boston, has just finished a study around interest rate normalization. And some prognostication on their part as to what they think is going to happen with interest rates over the coming, call it 10 years or so, and the impact that it could or could not have on commercial real estate. So it's their view that rates were falling before the global financial crisis because of the global demographic factors, which we'll talk about a little bit later on, and that those factors still remain. And while real and nominal long-term rates are likely going to increase to 2017 year, and in fact we're already seeing this, I actually prepared this before rates started to move up, they don't believe they're going to move up all that much. And so certainly the trend will be up, but we don't think the trend's going to be severely up, and therefore we believe it's going to have more of a dampened effect on commercial real estate than some might fear. We certainly see the possibility of policy rates, whether it's the Bank of England or Fed funds, moving up, but again within a reasonable range. And therefore, unlikely the rise in interest rates will be anywhere near as sharp as some investors fear. And I think while we still think it's a gradually rising environment, I would suggest this is probably good news, all things considered. So their analysis suggests that real inflation, long-term rates will increase to just 0.9% real rate of interest, right, including the inflation. And inflation will still stay fairly moderate at sort of the 2–2.5% range. And therefore, the impact on long-term interest rates is likely to be, and on cap rates, is likely to be small as the spread between cap rates and real interest rates fall back towards the more normal spread. We have still a fairly wide spread between interest rates and cap rates historically, and their belief is, therefore, that compression will help offset some of the rise in interest rates long-term, and that the global demographic trends will continue to press global interest rates for many years to come. Baby boomers saving for retirement, shift of manufacturing to Asia, increased global population of high net worth individuals, particularly in China and in India, and the falling cost of physical capital, mostly around technology. And then some prediction as to where rates are going to go in the UK and Germany, 2.5–2%. We can't forget that today we truly are a global capital economy. It's not just about US capital. And we're seeing this both on the debt side as well as on the equity side. So on the equity side, we continue to see interest from Australia, from Asia, less degree from Europe. We're actually seeing a lot of debt funds. The Koreans have decided that now at this point of the cycle, they want to be in debt. And so we're seeing a lot of, and the Australians. So we actually just raised a fund, a bridge fund, and the seed capital was an Australian institution. So it's kind of interesting to see at this point in the cycle where they choose to invest and still have a strong commitment to U.S. commercial real estate. So we know that the cap rate compression is certainly gone. We wouldn't suggest otherwise. But other factors to consider in terms of normalization, it's difficult for these pension funds to hit their returns. CalPERS has a projected return of all their investments blended of 7%. They actually need something closer to 8–8.5% to meet their obligations. And so when they lower those expected returns, they need to go back to the municipalities and have them tax more, which is obviously not a phone call that they want to be making. And so they're struggling, they're challenged in terms of how they meet the yields that they need. And they actually see commercial real estate as being a more predictable source of long-term income for them than some other alternatives. And particularly multifamily. When you take a look, as you all well know, the volatility of multifamily in terms of net cash flow in the business, it beats all other real estate type. It's a higher net cash flow, it's a lower volatility, and that exactly appeals to institutions, institutional investors, and what they need to accomplish. So what's the result of all this? Global capital flows continue to be unprecedented, unabated, and likely to extend beyond this cycle. I think this goes far beyond this cycle. Since 2009, global commercial real estate prices have risen by 85%. And we continue to see generally positive indices in terms of rents and values overall in commercial real estate when CB goes and does our survey every 6 months. So we're a long time into this cycle, there's no question. I'm not going to use the baseball analogy because I'm tired of that, and I'm sure you are as well. But I was just saying tonight at dinner before I got up here, it's my experience with clients, when I talk to them about the cycle as it sits now, they're actually more confident about this cycle enduring. They don't say necessarily how long, but they're not worried about it ending anytime soon. Than in my opinion, they were 2 years ago. There were more questions around the cycle, even in 2015, about how long it could go, because even then it was unprecedented. But we've all sort of gotten used to the conditions that have gotten us here, and I think we've started to accept the fact that these conditions are not temporary, that there's some fundamental changes that are going on. Now, nothing goes forever, but this is going to continue to likely be a very positive environment, all things being equal, for the foreseeable future. So let's talk a little bit, therefore, about the multifamily market overall. And we'll talk a little bit about absorption, deliveries, vacancy, rent growth, acquisitions, cap rates, returns, and then we'll spend just a brief amount of time on the debt market. So when you take a look at supply and demand, as I mentioned earlier, 229,000 units absorbed nationally over the last trailing 12 months. We're going to deliver somewhere around 310,000 units for the year, from as best we can tell. And by and large, we're absorbing most of what we're building. There's certainly some markets we'll talk about a little bit. There's seen some softness. There's certainly offering a month, 2 months concessions and lease-up. But generally what we're seeing in even those markets, once they get through lease-up, they don't have to offer concessions. There's certainly not concessions of that magnitude. And to me, that's the real litmus test. It's not so much that you're offering concessions during lease-up, but what happens once you've stabilized. And so far, the market seems to be able to absorb. And of course, it's the millennials, and it's also the baby boomers. So we're seeing baby boomers in some instances, we're just talking at dinner, be 35% of your resident profile. We've never seen this before, right? And I think that's only going to continue. The youngest baby boomer's 54 years old. So I think that has another 10 or 15 years to run. This is just a quick look at sort of deliveries to give you sort of a sense of where we're seeing deliveries. New York has had an unusual explosion of deliveries because there was a 421A tax law change that incented developers to build sooner than they otherwise would have. And so New York, quite frankly, has been soft for the last 3 or 4 years. New York and DC, in some ways, interesting enough, have been some of the most disappointing markets as a major market in terms of rent growth because of the amount of development that's going on there. And most of these markets, certainly New York, Dallas, DC, LA, Chicago, and Austin, are experiencing at least some temporary softness in lease-up. They're getting there. They're eventually getting stabilized, taking a little bit longer, as I said, taking a little bit more concessions than maybe what they need to do in the past. But by and large, they are getting leased. So now we take a look at the top 5 markets relative to units permitted, under construction, growth. And interestingly enough, when you take a look, and you'll see in terms of year-over-year rent growth, you see Houston, sort of in the middle of the page, 4.3%. Indianapolis, 3.3%, which in today's world is a pretty good number. Most markets are saying 2 to 3%. Jacksonville at 4.9%. Las Vegas, and Vegas was probably, Vegas and LA, probably the 2 markets that were the last to come out of the recession, and Vegas is doing exceptionally well right now. Vegas at 6.2%. Markets overall continue to perform reasonably well in terms of rent growth. We've got some other markets to take a quick look at. You take a look at the absorption numbers here. So Q 2018 units absorbed against Q2 2018 units completed. In almost every case, the number of units absorbed are equal to or greater than the number of units delivered. I would not have expected that at this point in the cycle. That's the kind of absorption we're seeing. And you take a look at the overall occupancy rates, and we're still 95+%. I wouldn't have predicted that. And we're getting average rent growth of 2 to 2.5%. Up by 80 basis points, Cincinnati up by 30. You see on the left-hand column, Cleveland up by 110, Detroit up by 10, Indianapolis up by 30, which is negligible. Minneapolis up by 60. So the Midwest is maybe feeling it just a little bit, nothing extraordinary. St. Louis is up by 140 basis points, and that's probably the largest increase we've seen in the Midwest, and in fact we've seen in most markets. Most of the other markets are holding their own, with maybe the exception of Nashville, which has certainly had a lot of supply. Sacramento, which has been on fire for 3 or 4 years and often leads the country in rent growth because it just haven't had that much supply relative to the demand. So overall, I would suggest while there's a little bit of movement in vacancy up, still nothing to get terribly excited about. So we take a look at the overall rent level relative to what the rent levels were in 2008. And as you can see, the markets that had the highest rent level growth are Colorado Springs, Oakland, West Coast markets, San Jose, Denver, San Francisco, Sacramento, Portland, all on the West Coast. And then you've got Orlando and Miami. So it's West Coast or it's Florida where you've seen the greatest growth, and obviously that sort of fits in terms of the migration that we're seeing and population growth. But still, fairly good growth overall for markets. Unfortunately, you don't see a whole lot of Midwest represented here in terms of rent growth relative to the rest of the market. Minneapolis, they're holding its own at roughly 25 to 30%. Chicago down there around 20%. So we like to take a look at and distinguish the different types of renters that we see in the market. We call them, as I'm sure you do, renters by necessity and renters by choice. And we've seen some trends over the last couple of years that continue, as you would imagine, and that renters by necessity, because obviously we're not building any new B product, are on average getting higher rent increases than renters by choice. So we're certainly seeing, again, the impact of supply in the core. We're seeing the softness in terms of the ability to raise rents. We're seeing pretty good rent growth overall. Renters by necessity, again, there's Vegas up there and Riverside, both doing well. Phoenix has actually been surprisingly strong. Phoenix, historically, as you all know, has been a fairly volatile market. I was talking to our Phoenix investment sales professionals the other day, and I said, is it becoming an institutional market? And they said, absolutely. And they're seeing institutional investors who never would have touched Phoenix 5, 6, 7, 8 years ago, absolutely coming in and invest. One of the things we took a look at in our Chicago conference were the Amazon 20. I don't know about you, but I was surprised about some of the cities in the Amazon 20. If you remember, it was Columbus, it was Pittsburgh, it was Raleigh, and not Indianapolis. Thank you, Indianapolis. How could I forget? And shame on me. Shame on me. But I didn't quite understand why. And some of it certainly had to do with universities, right? And so we worked with Yardi, and they did a little reverse engineering. We took a look at some of these cities, and they looked at the quality of technical skills of the population in these cities and the cost of that quality of skill, of labor. And they took a look at the cost and the technical skills of Silicon Valley and of Seattle. And of course, those are the high right-hand quadrant, highest quality, highest price. They're doing everything they can to get out of Silicon Valley and Seattle for anybody who doesn't absolutely have to be in Silicon Valley and Seattle for these tech firms going forward. And as a result, we're seeing them come to an Indianapolis, to an Orlando. Nobody would have thought Orlando was a tech city. Orlando is becoming a tech city. To a Raleigh, to a Columbus, because you've got Ohio State. Raleigh, because you have North Carolina State, and Duke. Even Phoenix, although it wasn't in the Amazon 20, has become more of a tech-type city because of Intel and the manufacturing that goes on there around tech. And you don't move those factories lightly. So it's interesting to us to see this sort of change in these economies as a result of these tech firms coming in and having a direct influence on what's going on in those cities, where they're building, who they're attracting, and how they're growing. And so, of course, what we all want to do is we want to find those cities that are going to be next Austin. So I would just encourage you to think about that as you look at these cities and really dive in a little more deeply in terms of what's going on with tech. You might be surprised. So anyway, that just gives you sort of a quick summary of the different rent levels by the different types of renter profiles. Having talked about tech, we see San Jose here at 7.9% in terms of a rent increase in 2018. Pretty substantial, again, at this point in the cycle. Orlando, we talked about it. I've never seen this in Orlando before. Another city that we would have argued was very volatile in the past at 7.4%, which seems to have changed the nature of its economy. Everybody I know who's invested in Orlando is very happy that they've done so. San Francisco, which was having some softness because of overbuilding, has come roaring back, and I'd argue that was the tech factor. It's now at 6.5% in terms of rent growth. Seattle, seemingly still doing fairly well at 5.8%. Vegas, a recovery. We talked about Tampa. The Tampa economy is changing somewhat. Tampa is reconstituting their downtown. You have Jeff Vinnick, who used to run the Magellan Fund for Fidelity. He owns the Lightning. He owns the stadium. He owns a lot of land around the stadium in downtown Tampa. It's actually a very interesting site. It's right on the harbor, and he's got Bill Gates' money as his capital. I would never bet against that combination. And they're going to transform downtown Tampa. So if you've got something in Tampa, congratulations. If you don't, you might want to think about going down to Tampa and taking a look. So we talk a little bit about the activity. People say, what are we seeing in terms of sales activity? Well, everybody heard the same thing at NMHC relative to the amount of capital is in the market and how much needed to be invested. And not surprising, we saw an increase in portfolios coming into the market. Sellers understanding this need to invest, this need for scale that we haven't seen before. You'll see the volume is a little bit higher than it was in 2017, and we weren't expecting that. We thought it might plateau off a little bit. We think we'll do about the same in 2018 as we did in 2017 overall. You see a slight tick up in individual assets, and you see a fairly significant increase in terms of mid-rise, high-rise at about 30%. So the activity is robust. We talked to our resident sales professionals. Fourth quarter, we think is going to be very active in terms of sales activity. I expect that that's going to roll into 2019. All development continue to go on. And quite frankly, just a lot of embedded gains that investors want to be able to take advantage of. So I think that's going to continue to fuel the activity. And I don't expect this to slow down any next year. So where is this activity happening? Well, interestingly enough, number one is tertiary southeast. You've all heard that people are stretching for yield, so you do that by strategy or do that by location. And so you can see the southeast tertiary markets where people believe that they can satisfy that need. Number one, see LA, Dallas, Atlanta, Houston, most of the major cities. You then see number 9, the tertiary southwest. And then you see number 17, the tertiary midwest. So there is certainly some interest, because you know there's not necessarily the volume or flow in St. Louis and Kansas City, which you all know better than I, or Indianapolis, but you see in some of these markets tend to be more buy and hold than necessarily buy and flip from what we can see. Oops. So we do a cap rate survey, and we update this twice a year. And this actually started in 08-09 when we didn't know what multifamily was worth. So we did this for our own benefit, quite frankly. We sat there and debated what it was worth. You remember those days? It wasn't that long ago. And so we put together a cap rate survey. It's now the single most called upon document on our website within the CB organization. So it's terrific that people see the value in it. We do this for all product types, not just for multifamily. And so I thought it'd be interesting to divide this out by cap rate levels. So tier 1 is 4.5 and under, tier 2, 4.5 to 5, tier 3, etc. If you take a look at tier 1, there's little inland empires in there, and I don't think, quite frankly, any of us would consider the inland empire to be a tier 1 market. The reason it's a tier 1 market is because it's a tier 1 market for industrial, and they didn't want to distinguish between industrial and multifamily and have different tier 1s. We arm wrestled over that. I said, fine. But I have to explain it to you because I wouldn't think of the inland empire as a tier 1 market for multifamily. But what you see here is the cap rate and then the Q2 rent growth. And you know, I was always taught in cap rates that a low cap rate should be indicative of high growth potential. And some of these markets, you don't see that. You don't see that in New York, Orange County. San Diego's not too bad. San Francisco, you haven't seen it. Although we showed earlier a number of 7%. Within the second quarter, it was just under 2%. So you take a look at the markets where you want to be and where you're going to get the best bang for the buck. And clearly, you can see Orlando at a 4.5 to 5 with 7% rent growth. Where you see Columbus, the Midwest well represented here, at a cap rate of 5.5 or higher, with a 4% rent growth. You know, that starts to make some sense for folks. Certainly Jacksonville I still have a hard time understanding why cap rates are as low as they are in New York, because by every measure that I've seen and every prognostication, nobody's expecting rents to go up a lot in New York, nor are they expecting rents to go up a lot in DC. And so we attribute that to a couple things. One, institutional investors, particularly foreign investors, feel they need to be in New York and DC. It's easy to explain to their investment committees, it's scale. And quite frankly, I think there's some pride and some ego engaged here. And so they feel that they need to be invested in those markets. Two, I think they feel because of the scale of those markets, the depth of those markets, that they're more liquid than some other markets, smaller markets, and they get some comfort knowing that if they had to, multifamily is probably the most liquid product that you can sell in a hurry if you really need liquidity really to fund. So we see this going on, we still scratch our head. Doesn't seem to make a lot of sense to us, but we're not smart in the market, so we'll just have to go with it. All right, now let's talk a little bit about the debt market. We've seen interest rates go up. I was a little surprised that interest rates moved, 10, 15, 20, 25 basis points over the last 3 weeks. I'm not exactly sure why that happened. I know the Fed was announcing they were going to raise rates, what they did yesterday. But I think everybody knew that probably a month or 6 weeks ago. So I can't tell you that's the reason. As we said, we do think the trend will be up over time, but we think it's going to be muted and therefore not have anywhere near the impact on values as people might suspect or be concerned about. Fannie and Freddie are having a record year. They will do probably something in the order of $140 billion worth of multifamily financing. That's just a phenomenal number. The market by the MBA measures is probably about $280 billion, give or take. I would argue, quite frankly, the market that Fannie and Freddie play in is actually smaller than that. So by their recollection, they believe it's 50% of the market. I'd argue Fannie and Freddie could well be 65% of the market. Insurance companies generally, total, all product types, might do about $75 billion a year. In multifamily, they might do 15 to 20. So we have a change in the FHFA director. The FHFA, again, is the regulator for Fannie and Freddie. Mel Watt, who has been incredibly user-friendly for Fannie and Freddie. He's been a gift from the Obama administration, particularly for multifamily. His term expires in January. And the three gentlemen whose names are being bandied about to be his replacement are the polar opposite. And they have us worried, quite frankly. If they come in, they have the authority, the power to be able to lower the cap. They have the ability to be able to tighten up on interest only, and the ability to tighten the box around green. So for those who are familiar with the green program, if you commit to do some work within your property that allows you to show savings of 25% on water or utilities, then you get a break in your financing. Historically, you don't get a break in financing. And if that's the case, it does not count against the cap. So to give you some sense of those numbers, cap this year is $35 billion. Freddie will probably do about $78 billion, which means they've got about $45 billion or so that doesn't fall under the cap, most of which is green. Same thing is true for Fannie and Mae. So this actually has an outsized impact, potentially, on how much capital might be available for 2019 from Fannie and Freddie. We also have a proposed capital standards come out from FHFA this fall, which doesn't affect Freddie because of the way that they transfer their credit risk and securitization and selling off the first loss piece. It has a very detrimental impact potentially on Fannie Mae because we take credit risk with Fannie Mae. We don't sell it off into the market. We are the credit risk transfer agent on the Fannie Mae program. So we're concerned about that and what that might mean in terms of Fannie Mae's ability to be competitive in the market going forward. We've made that concern known to FHFA. So I would argue that there's more uncertainty in 2019 around Fannie and Freddie than we've probably seen in the last 4 or 5 years. Now, it doesn't mean that anything's going to happen necessarily, but there are certainly more moving parts potentially. We have seen, as we talked about, this enormous amount of funds for debt. We saw pricing for debt for bridge that 12, 18 months ago might have been 350, 375 over LIBOR. You're struggling to try to get 250 if you're a debt fund right now. And I think that pressure is going to continue. So congratulations if you want to borrow from a debt fund. I think this is your time. I think you're going to have your pick of the litter, quite frankly, and you're going to have all the leverage. And we do see on the margin some debt funds going a little bit more aggressive in terms of lowering the cost of what we've seen in the past. We have seen the regulators under the Trump administration be a little bit more user-friendly with the banks. That's probably a good thing. But in our own book of business, and we'll do about $25, $26 billion worth of multifamily debt of some kind this year, we're down almost 20% in terms of our business with the banks. Everybody else we're up 20% with Fannie and Freddie. We're down about 20% with the banks. So we're certainly seeing some pullback with banks. We'll see if that continues in 2019. Boom. There we go. So, look, all things being equal, it's been a hell of a ride. And I think the ride's going to continue. There's always some uncertainty out there in terms of exactly which way we're going to go. But overall, I'll take our position. I think it's going to be good for the foreseeable future from everything that we see. I'm always looking over my shoulder, worried about what's catching up to me. But overall, I got to tell you, I'm still pretty optimistic, having said all that, about 2019. So with that, Steve?
Thank you, Peter. Thank you very much. Peter's on the front line of the capital markets like very few in this nation are, and Peter, we really appreciate you coming to town and sharing your insight with us. Thank you very much. All right, I'm going to dumb it way down now. Here we go. I'm going to go on record calling Lime and Bird change agents. Now, you're either fascinated by Lime and Bird or you're annoyed by them, like clearly this gentleman was when he stacked 35 scooters on top of each other in a trash can somewhere on the beach, probably in Venice, I imagine. And that looks like Venice Beach to me, I don't know. So, but here's why. This was on my drive-in just this morning. These are fresh catch photos. So I passed first two properties. This is Lux on the right and Axis on the left. First two properties I passed this morning. Both had Lime and Bird scooters out front. In fact, Axis might have had scooters on all four sides. I went around three sides, and three sides were definitely covered with scooters. So they're littering downtown. And I don't know, we probably have 500 scooters. They're on every corner now. In fact, Dane said he saw one as far north as 40th and Meridian. So here's why this is changing things. It's not the scooters themselves so much, it's what they represent. And it represents a shift from your own space, right in your own car. Look at Uber. You don't need to own your own vehicle anymore. We've got young people that are commuting, transporting themselves differently than they did before. And if you don't have Lime and Bird scooters outside of your building and you're in the urban space, you need to. And I think the next evolution here is figuring out how to partner with these operators and whoever the next ones are, and do your own charging stations so that for Bobby, the Bird Charger, apparently this is a real guy, Bobby the Bird Charger, doesn't have to ship his scooters. Anyway, so this is a small point that we need to be watching for these things that are happening in our industry because it's changing, and these things are here to stay. And they're cheap entertainment too. It's $1 on lock at 15 cents a minute. The Lamont family discovered these in San Diego on vacation this summer, and it was cheap entertainment for the kids, let me tell you. All right, so back on point here. Where are we in the cycle, and what's the capital saying? We could pretty much just end it with this first quote you see at the top. Higher interest rates plus late in the cycle equals lower cap rates, right? Makes sense. No, it doesn't make sense, but that's where we are, and that's what's happening. And that was a piece that Spencer Levy, who runs our econometric advisory shop, had in a July piece that he put together, and it's spot on. This is exactly what's happened this summer. I'll tell you a few stories as we go through my talk. And by the way, I'm going to try to get us out of here by 8:30, and I'm going to go really fast. This content is going to be difficult for you to read at the back of the room. It will be on our website shortly, so I'm going to fly through a lot of these slides, and you can pull down the data later if you're interested. So 2017, let's look back, because a lot of what we said last year is still in effect today. Insatiable appetite for well-located, not too old. Not too old is the key. 9-foot ceilings are important. Value-add product. And where we have that, it's 25 or 30 bidders. Institutional interest for large portfolios, value-add acquisitions, and value-add acquisitions in the Midwest. The Midwest, the secondary markets, you heard Peter say it, the tertiaries, they're on the grid now in a way they've never been before. And we're seeing capital that is looking at our markets that is forced to as they chase yield. New sources are still discovering Indianapolis. Every bidder list that we have in follow-up to the prior has multiple new sources of capital that we have to, we look at each other and say, wow, who are they? Well, we got to go figure out a new source because they're coming in from all sides. In fact, it's this wall of equity that Peter alluded to that I think gives this durability. I mean, the capital has tasted hard assets. The institutional sources, in the wake, this is going way back, in the wake of the dot-com bubble, had to go somewhere. They came to hard assets. And once you get that taste, it's like a shark tasting human flesh. Sorry to be graphic at dinner, but it's the same thing. You get that taste, and you need more. And so the capital is just not going to sit the sidelines. Look for current rent per foot and price per unit records to be shattered. That has happened this year, and that will continue to happen, we believe. So I'm not going to belabor this because Peter did a very good job talking about our national trends, but you see the orange cap rate line. It's continuing to nudge down, at least up through Q2. Interest rates are continuing to run, so we're beginning to see some correlation, particularly in the core space, between rate run and interest rates, which means the markets are doing what they're supposed to be doing, but there's still so much pressure to invest that we're not seeing certainly not seeing a direct correlation between cap rates and interest rates. In the value add space, forget about it. There is no, to date, there is no correlation between interest rate run and cap rates. And I've got a story about that I'll show in just a bit. So let's drill down to Indianapolis. Here's where we are year to date. $600 million's traded in the metro. There's enough under contract to perhaps equal the 2017 record of $730 million that traded in the Indy metro. The significance of this is that we're making our way up to the $1 billion mark, although we're not doing it very quickly, and I think that's an important psychological achievement for the market. Once we're trading $1 billion, it puts Indianapolis in a different league, puts Indianapolis in a relatively high velocity category that allows us to attract more capital than we can today because we're not necessarily a high velocity market. Where's the capital coming from? I mentioned this wall of capital. It's sort of it's sort of a five-dimensional wall of capital. We've got capital coming from the West Coast. It's been coming to the Midwest, Central U.S. secondary markets for years. Same with the East Coast. We've got Canadian capital that's coming, Mexican capital that's coming, and we've got offshore capital that's coming. On the Millhouse transaction, which we worked on last year, we at one point dotted the globe with 7 markers for regions of capital outside of the U.S. and outside of Mexico and Canada that were exploring the portfolio. That was completely unforeseen and not something that would have happened at any point prior. And we'll see that continue. That trend will continue. My personal theory on the offshore capital is that we've just scratched the surface. We're seeing the tip of the iceberg. And what I mean by that is the sources of offshore capital that are making their way to the U.S. are the institutional sources, the ultra high net worth, the sovereign wealth funds that have conduits to get here. And then there's the bottom, I don't know, pick a number, the bottom 90%, 70%, 95%. Nobody knows what that number is. It's just speculation. But it's an enormous amount of capital that's still locked up overseas that doesn't yet know how to get to the U.S., doesn't yet know how to get to these central U.S. secondary markets. But as those conduits unlock, there's a flow of capital that has the potential to erase any correlation between interest rates and cap rates, particularly in these lagging central U.S. markets like ours. It's an interesting thought to think about. We just don't know where the ceiling is on the potential for offshore. So we'll talk about a couple transactions here. This is an interesting one. This is a 600-unit property that we sold for Blackstone in Louisville, called Mallard Crossing. You see the old plantation house, which was actually at one point a working plantation house. I think the Brown family, not the Brown family that you're thinking of, but another famous Brown family in Louisville lived on this house. It's 200 years old, a lot of history. We sold it to Lifestyle Communities out of Columbus. So there's another sub-story that we're seeing developers now crossing into the acquisition space. We've seen J.C. Hart do that recently in Fishers.
We've seen others. Buckingham's another great example that's crossed into that space. And so as costs run up in the new construction space, as the lending environment for new construction tightens, we're seeing developers look at alternatives, and this is what Lifestyle did. Lifestyle bought an existing property that was 35 years old, actually didn't have 9-foot ceilings, but the location is phenomenal. It's in St. Matthews. And what's perhaps most interesting about this is that they have a proprietary restaurant brand called Goat, which you see in the top center and top left corner, that actually is self-sufficient. It's not a subsidized concept that they're putting into the Mallard Crossing clubhouse. So we're seeing operators look at new strategies like this that that knock down the walls between the residents and the community. And if you look at anything, if I could share one trend on the development side and the amenity space side that we're seeing in major markets, not really seeing it so much here yet, is the blurring of the property lines. So you think back to traditional rules. Traditional rules say, this is our clubhouse, this is our amenity center for the residents, and it's for their use only, which makes a lot of sense, or does it? If you're in an urban space and you've got ground level amenity space, you really want the public coming in to that space for two reasons. One, because you want to create a community sense, and you can't really do that with just the organic profile. And number two, it's really no-brainer marketing for future prospects. So we're seeing this happen in other markets. Haven't really seen it embraced here in the Midwest, at least not in the secondary markets, but we think that trend will be forthcoming. So back to a transaction story. So this was a portfolio that we took to market for a private Bloomington-based operator. There were two other properties that went with it, not shown here. So it was a 4-property portfolio, but these were two similar properties that went out together as sort of a sub-package of the 4-property package. We took this to market in November, early December of 2017. And remember, we haven't all gotten together here since 12 months ago, so we've got some stories that go back a bit. But this marketing spanned through December into January and February. And if you can remember what was happening in January through March of 2017, rates were running. And rates ran, I don't know, maybe 100 basis points during that period of time, which happened to be precisely when we were on the market and ultimately going through bidding on these two properties and the other two as well. So normally, you expect to see somewhat of a correlation between interest rates and cap rates. Not only was there no correlation here, but we were wrong by 100 basis points on this portfolio of product. We were wrong in the right direction, fortunately. There was not only no correlation, but there was a reverse correlation. I'm calling it a reverse correlation, but obviously there can't be a reverse correlation between cap rates and interest rates. It was just a function of too much capital in the market. And Indianapolis and lots of other markets like Indianapolis hitting the radar of national investors in a way that they never had before. So to offer a 624-unit suburban, well-located, value-add portfolio with 9-foot ceilings was a pretty remarkable offering that garnered 26 or 27 offers. And a surprising outcome on pricing. And that's a story that doesn't just apply here in Indianapolis. It's across the board where we're seeing this in the value-add space. And it's to the point in many instances where us intermediaries don't exactly know how to price assets. It's kind of like what Peter was talking about in 2009, 2010. What's it worth? There's no market. Well, we ask the same question today, although the market is robust, but we're just not quite sure where the ceiling is. I mentioned the Millhouse portfolio, urban core portfolio was what we dubbed this portfolio. And the interesting story here was that this came to market when there was nothing of any core nature, of any size on the market. It's actually rolled out in January of 2017. We debuted this at the NMHC show, which was in San Diego that particular year. And we were looked at kind of crossways by some who said you're going to market with almost a $500 million core portfolio. And this is when core had, the pendulum swings both ways when core was falling out of favor. but there was nothing like it on the market. Ultimately, we had 20 bids, and the portfolio got broken up into several transactions, one of which was a significant recap by a group out of San Francisco called Stepstone, which is a $30 billion private equity shop. So actually, I had a conversation with one of the Stepstone guys just a week ago or so, and we were just talking about this stage in the market and where we are, how they see the world. And his comment to me was very interesting. He opened it with, at this stage in the cycle, and that's a perfect setup for somebody to express a negative opinion about where they think we're going over the next 12 or 18 months. He proceeded to tell me how every other asset class has challenges. Retail's like catching a falling knife, was his direct quote. Office, hotel have unnecessary risk and volatility built into it. Industrial is white hot. If apartments are red hot, industrial is white hot. And the yields just aren't there, which leaves multifamily. And for high 4s and to middle 5 caps in multifamily space, Stepstone and other groups like them are going heavy and hitting the gas as hard as they can to put out as much capital into this environment. So we like to speculate on where cap rates are for pre-stabilized offerings, and there aren't too many pre-stabilized trades that occur. But this is one of my favorite concepts, where we can be theoretical and opine on where we think the pre-stab space is. So it's kind of a continuum that you see here, where we're progressing up in discounts, starting with the urban space and moving up into the suburban space. So basically what we're saying is similar to what we showed last year, where we think a 75% leased urban offering will trade at somewhere between 0 and 25 basis point higher cap rate than it would if it were stabilized. And I'm not going to read all the different data points, but you can see how it progresses as you go up into the suburbs. We've added another component over to the left, which is an 85% offering. So what we see here is an asset that is moving through lease up with good velocity, not hitting stalls, not offering undue concessions. That's essentially a stabilized asset. That asset will be stabilized by the time bids are collected or PSA is executed, or certainly by the time the 30-day inspection period is up. So for that asset, we're saying effectively no discount. The velocity is the key, though. If velocity is lacking, then it's a different equation. All right, so this is my favorite of the pieces of data that we look at. This is the risk premium. So what are you paid for operating multifamily? And these are based on Indianapolis A and B grade transactions that have happened over the last 12 or 13 years. And what we see here is back in 2005, 2006, and into 2007, so the end of the last peak cycle, that premium for operating multifamily was razor thin. It's 100 basis points, plus or minus. In many markets, it was inverted. You were paying effectively to acquire and operate multifamily. And we see it exploded to almost 500 basis points in Indianapolis. As interest rates bottomed out, we see an average of 184 on the 10-year in 2012. Right here. 480 basis point spread. So it paid very well for the commensurate risk with multifamily. Then those spreads compress as interest rates begin to move up, cap rates come down, and even still, we're at 250 basis points year to date on A and B grade transactions in Indianapolis. A long way, I would argue, from where we came at the end of the last cycle. Which is to say that there's probably still some more cushion for absorbing interest rates. This is the question that we all ask ourselves: when will the correlation exist? And we're on the edge, probably, where we'll start to see some positive correlation, particularly in the core space, with much more continued interest rate movement. Okay, hard shift to job growth. I'm going to fly through this stuff. Short story here is we've added 20% of the 2010 jobs denominator since 2010. That's a pretty remarkable accomplishment here in the Indianapolis metropolitan area. And how does that stack up to our peers? I think the interesting story here in this slide is that we are second place to Kansas City in the Midwest for most dynamic job growth. And the capital is taking note of that. I'm going to fly through housing and a couple other things, back to more on jobs. So the most interesting thing to talk about is, as we're having conversations with capital sources, particularly new capital sources that are considering Indianapolis for the first time, is the tech story. The tech story is rich in Indianapolis. So this is the brain drain. Brain drain or brain gain. And Indianapolis, let's find it here, we are up 4,200 jobs on a net basis on in the tech space. That puts us in the upper third as you compare with our peers throughout the rest of the country. And let's look at some of these markets. Let's pick on the low ones. Washington, D.C. losing 48,000 jobs. San Francisco Bay Area gaining 46,000 jobs. So we're more than somewhere in the middle. Also interesting to look at is the labor cost here. This is really blurry. I'm going to show you where Indianapolis is, if I can find it myself. We're right here in the middle somewhere. Where are we? There we are. Yeah, okay, right there. Okay, so this is measuring labor quality with cost of labor. What's labor quality? They're measuring degrees of those in the tech space from top 25 information sciences programs in the nation. So we've got a high-quality tech labor force with a low cost of labor, which is exactly why groups like Salesforce are dropping major flags in the market. I'm not going to read through the list of headlines. You read them every day. Indy's on the radar, and it's easier each time we take every quarter, every 6 months, whatever metric you want to use, a little easier for us to sell the Indianapolis story because of all the things that are happening in our market. All right, building permits. Let's start moving into construction. So we're seeing stable multifamily permit activity. Single family obviously moving up. Nationwide, single family housing values are up 5% year over year. So the hard reality that homeowners have had to accept over the last decade, that homes are not necessarily an investment anymore, that's beginning to erode a bit, and we're seeing some appreciation, seeing an uptick, measurable uptick in single family permit activity. Which brings us to the question, where are we in this cycle? If you look at CBRE research positioning, we've got multifamily heading toward a decline, but what does that decline look like? It's not necessarily what we've seen in the past. I think it's short-sighted to expect that multifamily will follow the national economy. And I might have shared my analogy, my very non-economic analogy, which I call the space shuttle theory. So if you've heard it, I apologize. You'll have to hear this again. But the space shuttle theory is essentially this. You think about the space shuttle and how it blasted off under the power of the solid rocket boosters. And then once it's up into altitude, the boosters peel off, and the space shuttle keeps on cruising. So there's my very simplistic analogy, my correlation between the apartment market and the national economy. I see the space shuttle as the apartment market, the boosters as the national economy. We know that we're going to nose into a recession. We don't know when, 12, 18, 24, 36 months, somewhere in that window, very likely. But the apartment market doesn't have to follow just because it always has in the past. Things are very different today. The rules are different, the fundamentals are different, the demand is different on both the user side and the investor side. And I see a very gradual tapering off, which represents the detachment from the national economy. Okay, so let's take a look at actual deliveries. Historic in the green, we peak in 2016 with 4,000 units. That was a hard year. 17 actually was a hard year, as we absorbed the deliveries of 16. But what we're seeing here going forward are very absorbable levels that as you look back over a 25, 30-year period of time are in line with historical patterns. So we're going through some speed bumps right now in certain submarkets. I know downtown there are spots where we've seen particularly lease-up related heavy concessionary activity. Carmel's gone through its softness, but these are temporary blips given the demand that we see, the influx of smart millennial tech talent that's come into the city, and I think that I think that as if we went through the audience here and took polls on concern over supply, I'm guessing that most would say, well, we're watching it, but believe that we have manageable levels of supply in most submarkets. And what's very different about the supply today than in prior years, you look back a decade and certainly 2 decades, is where it's being built. I'm going to go back to that slide I just showed in a second. But what I want you to focus on here are the dots. This is impossible for you to read. This will be online, so you can get it later. But look at where the construction is being built. It's very concentrated. It's Carmel. It's Broad Ripple. A few years ago, we saw the 86th Street corridor, Keystone the Crossing, getting built out. It's Hendricks County, Brownsburg, Avon, Plainfield. And then, of course, downtown. So it's intelligent supply that's being built in the right locations versus every other cornfield like we saw 10, 15, 20 years ago. I mentioned the breaking down of the walls in the amenity space, so I'll move forward on this one. I know we talked about Quarry last year because it represented a high water mark in the suburbs. By the way, I would love to be able to play-by-play go through all of my friends and clients' creations. I would love to be able to do that, but I can't. I'm not picking favorites here, just picking some that have a couple interesting talking points like they all do. But the one here is $1.65 rents. These were not on the board in the suburbs 3 years ago. But Glick has delivered an exceptional product. And what you see here is one of the penthouse units on the upper floors, which are pretty phenomenal. Mass Avenue, latest addition to the dead center of Mass Avenue is Penrose on Mass, which will come in somewhere between $1.85 and $2, maybe $2.05. Do I hear $2.05, John, Michael? Going. The Star site has been reborn with the addition of the Wit, which is working through completion of construction now and lease up. And of course, the tower. I joke with those that are outside the market coming in to look at Indianapolis for the first time that we build a tower every 50 years, and here's this 50 years tower. And actually, Buckingham is under construction with a tower as well on their Cityway campus. But the interesting story here is, as you all know, is the 250 target. So Flaherty & Collins has essentially skipped over a 50-cent chunk of space that there's nobody in that space between $2 and $2.50, leaped right over them, and is getting $2.50 a foot for some pretty phenomenal views throughout the building. And then the student space is continuing to evolve. We see the hub at Purdue getting $1,000, $1,400 per bed rents. Trinitas doing new work in the Cincinnati market with the Deacon, with average rents approaching $900 a bed. The large range of units from studios through 4 bedrooms. And we'll continue to see these niche, what used to be a niche, and student housing was certainly a niche 10 years ago, 20 years ago, become more institutionalized, whether it's senior housing, student housing, or other niches. So in conclusion, a couple thoughts that these don't change a whole lot over the years because we're in this trend where we're continuing to see new capital. We'll continue to see new sources that are looking for bulk. That's one of the key elements of this environment that we're in right now. We're hearing a lot of chatter from groups saying we'd rather put out $50 million than $15 million in equity. And the ability to take down large portfolios is real. There is a portfolio premium in place. It's difficult to quantify. We call it between 10 and 25 basis points, but it's very real. And we think those trends, those investor trends, will continue and intensify as this wall of capital that we've talked about continues to grow. Levels of supply are absorbable, and as Peter did, I'm going to end on a high note and speculate that this run is far from over. It might look different in 2 years than it does today, but the environment is phenomenal and the fundamentals are intact in spite of supply.